Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. Today we're diving into Global Medical REIT Incorporated's latest report, and let's just say it is a story of some ups and downs, or perhaps more accurately, some losses and some strategic moves. Stick around because we're going to break down what these numbers really mean for the company and its investors. And before we dive in, if you love getting the real story behind the corporate jargon, smash that subscribe button. We also have a fantastic community over on Discord where we talk all things finance and investing. So check out that link in the description below. Alright, let's get right into it. This report is from November of 2025, giving us a look at the company's performance leading up to that point. Global Medical REIT Incorporated, or GMRE as you might know it, is primarily focused on owning medical office buildings and healthcare facilities. Think of them as real estate investors, specifically in the healthcare world. Now, the headline news, and it is not the prettiest picture. For the third quarter of 2025, the company reported a net loss attributable to common stockholders of about $6 million. Ouch, to put that in perspective, this is a shift from the previous year when they actually had a net income, a profit of about $1.8 million. So, they've gone from making money to losing money in the same quarter, year over year, and it is not just the short term. Looking at the 9-month period ending the 30th of September 2025, the net loss attributable to common stockholders was around $4.7 million. Again, this is a worse situation compared to the prior year when their net loss was much smaller, about $0.6 million. This trend of increasing losses is definitely something to watch. But it is not all bad news. While the overall profit picture is concerning, they did report a positive growth in what is called same-store cash net operating income, or NOI, for the third quarter of 2025. This grew by 2.7% compared to the same period last year. This metric is important because it looks at the income generated from properties they've owned and operated for a full year. It tells us that the buildings they already had are still performing, at least in terms of their core operations, even if other expenses are eating into profits. Let's talk about their real estate empire. As of the 30th of September 2025, their portfolio was about 95.2% occupied. That is a pretty good occupancy rate, meaning most of their available space is being rented out. They have about 5.2 million square feet of leasable space, generating an annualized base rent of around $118.4 million. Their portfolio is split across different types of medical facilities. About 72% is outpatient medical buildings, which are typically doctors' offices and clinics. Then there are inpatient rehabilitation facilities, hospitals, and long-term acute care hospitals making up about 25%. The remaining 3% is other medical real estate like behavioral health centers, offices, and retail spaces tied to healthcare. The average length of their leases is 5.3 years. This means that, on average, tenants are committed to paying rent for over 5 years. This provides a degree of stability and predictable income, which is generally a good thing for a real estate company. Now, let's dive into the lease expiration schedule. This table shows us when their leases are set to expire, broken down by year based on the annualized base rent. This is crucial because it tells us when they might have to renegotiate leases or potentially face vacant properties. You can see that in 2025, only about 0.6% of their total square footage is set to expire, which is a very small amount. Looking ahead to 2026, about 11.7% of the total square footage has leases expiring. Then it is 10.6% in 2027, 5.9% in 2028, and then a bigger chunk of 14.4% in 2029. Following that, we see 14.2% in 2030, 11.7% in 2031. And then smaller percentages in the following years, with a significant 15.8% expiring in 2035 and beyond. This distribution is relatively balanced, with no single year showing an overwhelmingly large percentage of expirations all at once, which is good for managing risk. It is important to understand how they calculate annualized base rent. They take the monthly rent from September 2025 and multiply it by 12. So it is a snapshot of their rent income at a specific point in time. This figure doesn't account for future rent increases, new leases, or leases that are expiring. Also, if a property is in a free rent period for a tenant or rent is collected on a cash basis, it is not included here. This means the actual rent collected or available could be different. Let's unpack some of the more technical financial terms they use. They talk a lot about EBITDA and adjusted EBITDA. Think of these as measures of a company's operating performance before accounting for certain expenses like interest, taxes, depreciation, and amortization, as well as gains or losses from property sales and impairments. Adjusted EBITDA further adds back non-cash expenses like stock compensation and adjustments for various other items. Essentially, they are trying to show the cash generating ability of their core operations. Management considers these measures important because they provide a clearer picture of their ability to manage their debts and compare their performance to other companies. They also define net debt. This is their total debt minus their cash and cash equivalents. They believe this gives a better view of their actual borrowing obligations. Then there is net operating income, or NOI. This is considered a measure of the core profitability of their properties. They define it by adding back expenses like depreciation, general and administrative costs, interest, and other non-operating items to their net income. Cash NOI is similar but excludes non-cash items like rent over time. Same. Store cash NOI compares the cash NOI of properties that have been operating for the entire reporting period both this year and last year. This helps to focus on the performance of their established, stabilized properties. Now, let's look at the numbers that support these definitions. In the table showing the reconciliation of net income to EBITDA and adjusted EBITDA, we can see some key figures. For the 3 months ended the 30th of September 2025, their net loss was negative $5,058,000, meaning a loss of $5.06 million. Compare that to the same period in 2024, where they had a net income of positive $339,000 or $3.39 million. That is a significant swing from profitability to a loss. Their reported EBITDA for the third quarter of 2025 was $24,224,000 or $24.2 million. This is up slightly from $22,446,000 or $22.4 million in the same quarter of 2024. This shows that despite the net loss, their core operating earnings before certain expenses have actually increased. And their adjusted EBITDA for the third quarter of 2025 was $25,714,000 or $25.7 million, also up a bit from $24,000 and $2,000 or $24.0 million in 2024. On the debt side, their total gross debt stood at $712,853,000 or $712.9 million in 2025. This is a substantial increase from $634,324,000 or $634.3 million in 2024. This increased debt leads to a net debt of $705,730,000 or $7.06 million in 2025, up from $628,601,000 or $628.6 million in the previous year. And this is where the leverage starts to show. Their net debt to annualized adjusted EBITDA ratio was 6.9x in 2025. This means it would take them about 6.9 years of their adjusted operating earnings to pay off their net debt. In 2024, this ratio was 6.5x. So, their debt burden relative to their earnings has increased. Looking at the NOI reconciliation table, we see a clearer picture of property level performance. Again, the net loss for the third quarter of 2025 was negative $5,058,000 compared to a positive $3,391,000 in 2024. But their NOI, the income from their properties before other expenses, was $29,000 and $5,000 or $29 million for the third quarter of 2025. This is up from $26,827,000 or $26.8 million in the same quarter of 2024. So their properties are generating more income. Their cash NOI, which excludes non-cash items, was $28,786,000 or $28.8 million for the third quarter of 2025, an increase from $26,608,000 or $26.6 million in 2024. And the same store cash NOI, which focuses on consistently operating properties, was $25,292,000 or $25.3 million for the third quarter of 2025. This is up from $24,639,000 or $24.6 million in 2024. So, the underlying real estate operations are indeed performing well. The report is signed off by Jamie A. Barber, Secretary and General Counsel, on the 13th of November, 2025. So, what is the story here? Global Medical REIT Inc. is in a bit of a pickle. Their core real estate assets are performing well, as shown by the growing NOI. The occupancy rates are high and average lease terms are decent, suggesting stability in their rental income from existing properties. However, the company is struggling with profitability, evident in the net losses for both the quarter and the year to date period. This is likely due to a combination of increased expenses, potentially interest expenses on their rising debt, and possibly other operational costs not directly tied to property income. The rising debt levels are a significant concern. A higher net debt to adjusted EBITDA ratio means the company has more debt relative to its earnings power, which can increase financial risk, while they are growing their property income. The overall profitability is hampered. The challenge for Global Medical REIT will be to either significantly grow its net income beyond just the property operations or to manage its debt more effectively. They have a solid portfolio of medical real estate, which is a generally stable sector. The risk lies in their ability to manage their financial leverage and turn those property gains into actual company profit. A key opportunity would be to find ways to increase rental income through strategic acquisitions that are accretive to earnings or to optimize their debt structure for investors. The current trend of increasing losses coupled with rising debt, despite positive operational metrics, warrants caution. It is a battle between strong underlying asset performance and significant financial headwinds. Alright, that is our breakdown of Global Medical REIT Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they can turn the tide on those net losses, or is their rising debt a red flag? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and don't forget to subscribe for more deep dives into corporate filings. And as always, check out the Discord community linked in the description for more great discussions. Thanks for watching, and we'll see you in the next one.